Hello everyone, and welcome to Alternative Design's presentation of You Have Questions and We Have Answers. This is Tim Harding. I'm the Chief Marketing Officer for Alternative Design, and it's nice to be back after missing a week last week. I had the pleasure of going up to the University of California, or State University of California Long Beach campus and watching my son, my youngest son, graduate, and so we found out he was telling us the truth. his name was in the program, and he did indeed get to walk across the stage and receive his degree. So missed last week, but sure had a good time being away. It is, however, very nice to be back, and since we're at that in-between stage where we are lacking any product to talk about, next week will be the product launch. We should have the products available by next Wednesday, but nothing right now. I thought this would be a good time to pause and just do a review. Every so often I like to walk through the top questions that we get asked. Many of you haven't thought of the question to ask yet, or you haven't gotten the answer yet. Some of you have heard these before, but having heard them before, you know, repetition isn't necessarily a bad thing. Very often it's a good thing. And so this can be treated as somewhat of a refresher for you, just to remind you of some of the features and some of the procedures and processes that are involved with market-linked CDs. So as always, if you have questions that I don't come up with in this particular presentation, please feel free at any time to type them into the chat box on your control panel. And as always, I will take some time at the end of today's presentation, after I've asked all of my questions and given all of my answers to my own questions. I'll be happy to take any additional questions that you have and take my best shot at answering those, as always. So we'll go through these in a fairly rapid manner because I know many of you have had these issues addressed before. But I do want to do this review and cover many things that we cover on an ongoing basis. Get asked very often, how are the banks and the products on the Alternative Design platform selected? You know, how do we choose the 5 or 6 that we feature every month? That's a good question, and it's important for you to understand if you haven't thought of this before. There are hundreds of market-linked CDs available on the marketplace, and those offerings come out, as you know, the first of every month. When that happens, Chris Gross spends a great deal of time going through each and every one of those offerings, analyzing the terms, analyzing the compensation, analyzing, sorting the good from the bad. You know, just because it happens to be a fixed indexed annuity doesn't mean it's a good fixed indexed annuity. The same is true of market-linked CDs. Just because it's an MLCD does not mean that it's one that we would want to put on our platform. And then Chris selects several, and we sit around and have a management discussion about which ones we feel would be most appropriate for the given month. You'll find some consistency there, because if there are features that we liked in a particular offering and the bank repeats it in subsequent months, we're very likely to continue to like it as well. So you won't see a lot of turnover, a lot of change in the products that we put on our platform, but you will see some. But please keep in mind, we don't pick these arbitrarily. We do put a great deal of effort into choosing the ones that we think are best for the consumer, best for you as well. So that's where they come from. By the way, another question I get asked is, well, you know, are these the only ones available? And the answer, of course, is no. We have access to virtually all of the bank offerings out there. And in those circumstances where another bank is required, we can certainly access them. So two things to keep in mind in this regard, and that is, number one, there is a great deal of care taken in choosing the offerings that we put on our platform. However, we do have the universe of market-linked CDs available to us, and in appropriate circumstances, we're able to access those for you as well. So just because it's not on our platform doesn't mean it is not available. It just means we have chosen not to feature it for that particular month. Another question I get asked all the time is, could a prospect buy a market-linked CD directly from the bank? Well, the technical answer to that is no. They cannot buy it directly from the bank unless they have $5 to $10 million, in which case the bank would be happy to speak to them about issuing a CD directly to them. All of these CDs are issued through what is known as a deposit broker, and there must be a custodian with the capacity to hold electronic evidences of the CD for the benefit of the client. So if a client were to walk into a branch office of a major bank and ask about a MarketLink CD, the teller probably wouldn't know what they were talking about. But on the off chance that they did, what that teller would do would be to direct them over to that little corner of the lobby where the bank's broker-dealer is sitting. And the client would have the appearance of purchasing the MarketLink CD directly from the bank, but in fact would be purchasing it through the bank's broker-dealer. And in order to do that, they would have to set up a custodial brokerage account with that broker-dealer, for which there would be a fee. And oh, by the way, there is absolutely no benefit to the client for going through that broker-dealer as opposed to going through you. In fact, in all likelihood, the brokerage fees on that transaction and to maintain that account for the duration of the CD would likely greatly exceed the fees that are charged by our custodian, Provident. So the direct answer is no, you can't buy it directly from the bank. You're always going through a deposit broker. Might be the bank's deposit broker, but you're always going to go through a third party in order to acquire these. Get asked how the referral fees are determined, and that's the answer to that one is very simple and straightforward. It's determined by the bank. When the banks come out with their offerings, they publish what they're willing to pay in terms of the referral fee. And sometimes they're not willing to pay very much, and in those cases we're not going to feature their product on our platform. We're very, very aware that the compensation we're able to pay in the form of these referral fees is significantly less than what you could get on a fixed indexed annuity. But we do push the banks to offer as large a referral fee as possible, and in recent months have been able to get them to bump it up a little bit, and you've seen that reflected in our standard compensation, which has gone from on average 2% now up to about 2.5% on most of the products. Certainly the 7-year products are now at 2.5%. But those fees are not determined by us. They're determined by the banks on a monthly basis. You know, we have a minimum account size of $25,000, but I want to emphasize that that is the minimum account size. The CDs themselves are actually issued in $1,000 denominations, which means that as long as you satisfy the minimum of the $25,000 account size, you can break that $25,000 down into several CDs in increments of $1,000. So you could, for example, put $12,000 into a commodity link CD and $13,000 into a stock link CD, and that would satisfy the minimum account value of $25,000. Can we make exceptions to that $25,000 minimum? The answer to that question is yes. However, the main thing to consider on the reduced minimum deposit is that Provident, as custodian, is going to be charging a $50 fee starting in the second year to maintain the account. And if you have a small account that's not generating very much interest, that $50 fee can have a substantial impact. So yes, we do on occasion make exceptions if you've got a good reason and go below the $25,000 minimum account size. But there needs to be careful consideration before that is done. For those of you who are new with this and have yet to take your first application, you may be wondering why the check is made out to Provident Trust and not directly to the bank. And the answer is very simple. Provident Trust is the deposit broker in this transaction. They are going to be the custodian. So what the client does when they fill out the application for Provident Trust is they're actually filling out an application not to purchase a CD, but to open a self-directed custodial trust account, which is set up to hold evidence of the CD for their benefit once Provident Trust purchases the CDs for them. So the check needs to be made out to Provident because Provident is the one that's going to be purchasing the CDs for the benefit of the client. Does my client get a physical certificate of deposit? Well, as I've already alluded to so far in this webinar, no, there is no physical certificate of deposit issued when a client purchases a market-linked CD. Instead, delivery is digital and is held by the custodian, in our case Provident Trust, in digital form, in electronic form, for the benefit of the client. This is what's called a DTC transaction. Thousands upon thousands upon thousands of these transactions take place all day long because this is the way that stocks and bonds and securities are transacted. This is also the direction that most banks are going for the vast majority of their transactions as well. So it may not be a common event yet in the insurance world, but in the securities and banking world, electronic evidence is the norm, not the exception. If your client has concerns about not receiving a physical certificate, it is clearly explained in the disclosure documents that you provide them with, and they will get a number of things to confirm the CD from the custodian, Provident Trust. They're going to get a welcome and an account statement when they open the account. They're going to get an updated account statement when the CD is actually purchased on the closing date, and then they are going to receive statements anytime there is activity such as interest being paid inside that account from Provident Trust, and they will always be able to access their account online and take a look at it if they like. Well, as I mentioned in the previous question, the closing date. So another good question would be, okay, where's the money prior to that settlement date, prior to that closing date? When Provident Trust receives the money from your clients, it is immediately deposited into an FDIC insured account at a bank there in Nevada. FDIC insured from the moment Provident has it. Provident never actually holds the money. They are what's referred to as a non-depository trust company. So the funds have to be deposited elsewhere, and your client's funds are FDIC insured even if the money comes in early in the month, and they have to wait even a week or two prior to the actual purchase of the CD on the settlement date. Those funds are always FDIC insured and never at risk because Provident does not hold those funds themselves. Okay, what happens when interest is paid annually? Very simply, when interest is declared and paid by the banks to Provident, Provident deposits that money into the custodial trust account for your client and notifies them that interest has been paid and awaits instructions as to what to do with it. If there are no instructions, it will simply sit in a money market account earning money market rates until your client directs Provident Trust to do something different with it. By the way, if interest is going to be paid to one of your clients, you're notified ahead of time so that you know that that interest payment is about to be made. This is a great time to schedule an annual review and get together with your clients and talk about what to do with that interest payment. Very often we find that an additional deposit is picked up because of the timing. So the interest payment goes directly into the Provident custodial account, awaiting direction from your client. Of course, since the CDs are issued in $1,000 increments, and since they've already satisfied the minimum of a $25,000 account, they can use, if they choose with your advice, to purchase additional CDs. They may do so in $1,000 increments, or they may simply have the money sent to them in cash. You know, liquidity is always a question with the market-linked CDs. 7 years is a little bit longer than a traditional CD. Clients are often used to seeing 30-day, 90-day, 6-month, 1-year, 3-year CDs, as well as the 5-year jumbo CDs. But 7 years is even a little bit longer than that 5-year jumbo CD. So we always get asked the question, and clients are always going to ask the question, what if I need to get out early? Well, it's important here to make a distinction between liquidity, which is the ability to get out, and maturity, which is the date at which the bank promises a full 100% return of the initial principal. So the 7-year CDs that we offer have a 7-year maturity, but there is no surrender charge. There is no penalty for early withdrawal. In fact, they're very much like a U.S. government bond. You know, if you hold it to maturity, you're guaranteed to get 100% of your principal back. However, if you want to get out prior to maturity, you can. You simply have to sell the government bond for whatever the current market value is. And that could be less or it could be more than the original principal amount, depending, for example, upon what interest rates have done. The same is true of a market-linked CD. If you want to get out early, you can. You simply have to redeem it or sell it back to the bank at whatever the current market value of that CD is. And it could, of course, be less or more than the original principal amount. But these CDs are liquid, and keep in mind, they're liquid in $1,000 increments. So if you have a client who put $100,000 into a CD and then has an emergency and needs $10,000, you would simply liquidate 10 or 11 of the CDs in order to satisfy that. They wouldn't have to make a decision of all or nothing. So there is a significant amount of liquidity in the product. However, no client should ever go into one of these products without the expectation that they will leave the money on deposit until maturity. I get asked a lot how the stocks or commodities in the basket are chosen. And the best answer I can give on that is they're chosen by professionals at the trading desks of these global banks. But banks in general do not like volatility. They do not like volatility. Therefore, in terms of stocks in particular, what you're typically going to find is that they've chosen large cap, big companies with big market share, value stocks. Value stocks are stocks that the banks perceive to be undervalued. In other words, they don't have to do better than they're doing in order to turn a profit over the term of the CD. They anticipate that over time, not immediately, but over time, these stocks will grow in price to their full value and even beyond. The problem with value stocks is they're not going to turn around just because a bank chose them and put them into a CD. In fact, if you look carefully into the disclosure documents and you see the historical performance of some of the stocks that they have chosen, you'll see that they have been underperforming. Value stocks, by definition, are underperforming. They're bargains. They're selling below what they're really worth. And so you're typically going to see stocks that have not done well in recent history. That's what the banks like about them. They believe that all the other factors, the dividends, their profitability, economic conditions, and so forth, indicate that the stock should be worth more than they're paying right now. So because of this strategy of choosing large cap value stocks, you create some dynamics within the product itself that you should be aware of and you should use to help set expectations with your clients as you're talking with them. Because these are large cap value stocks, the probabilities of getting the minimum interest, whether that's 1 or 1.5% or 0, is greatest in the early years. As I mentioned, value stocks aren't going to turn around and start going up just because a bank chose them for that particular offering. They're probably going to hang out in the same neighborhood for a little while. So it would be typical of a stock-linked CD to get the minimum return in the early years. But of course, the longer you hold a value stock, the greater the probability of getting the higher returns. And so the way the dynamics in these products typically work is you have a situation where it starts with lower returns and they gradually increase over time, so that the longer the CD is held, the more profitable it becomes. We get asked all the time, can you put market-linked CDs into an IRA? And of course the answer is yes. It's a very, very appropriate use of the product. So do not be afraid of qualified money. There's tons of qualified money sitting out there, and baby boomers at this point with that qualified money really shouldn't be taking much risk with that money. They should be capturing their gains right now because the stock market has had a nice run, and they should be locking it up because for all practical purposes they can't afford another major market correction to hit their portfolio. We get asked often, what happens with the required minimum distributions inside the CDs since the CD pays annual interest. First of all, if no RMD is required, the interest is simply held in a money market account inside the qualified plan, so there is no forced distribution of the interest payment. It still stays qualified money. But if an RMD is required, Provident Trust will do whatever the client likes. They will hold the CDs till maturity and simply move them into a non-qualified account to satisfy the RMDs, or they will liquidate CDs if the interest is insufficient to meet the RMD requirement. But the client actually has a couple of options with how those RMDs are handled, and Provident those folks are experts on qualified money. Their claim to fame is their ability to manage self-directed IRA accounts, and so they're very, very proficient in this area. Can an association or a nonprofit or a church purchase a market-linked CD? The answer is absolutely, and I talk about this frequently. It's a great way to get in front of new markets, and I'll be talking more about that throughout the rest of the year. I've already talked about it some, and we'll continue to talk about it because with the FDIC-insured market-linked CD, you have some opportunities to get in front of markets that you might not have even been aware of. Can a trust own a market-linked CD? Yes, absolutely. We do it all the time, every single month. We have a number of CDs purchased by living trusts and even several types of trusts. So the short answer is yes, a trust can own a market-linked CD. When you first look at the first page of the disclosure documents, there's a section there that talks about a placement fee. If I were a client or prospect for this product and I had just looked at that front page, I'd want to know who pays that. And the answer is that's a fee that's paid by the bank. A fee that's paid by the bank. It's not paid by the client. Your client's account will always reflect 100% of their initial deposit. They put $100,000 in. They have a $100,000 CD account. That placement fee is paid by the bank and not by the client. Very often after an interest payment, client finds additional money. Very often the second sale is bigger than the first sale. And so if they already have an account at Provident Trust, how do they add money to that existing account? Well, clearly they can't purchase the original CD. They're going to have to purchase a new CD. But to accomplish that, it's very simple. Only one page out of the Provident application is necessary, and that is the direction of investment page. Because the account is already opened and established, only that one page is necessary for additional funds to be put into that trust account, and that is the direction of investment, where the client instructs Provident Trust what to do with those funds. So very simple to add money to the account. Even though you can't put money into the same CDs, you can put money into newly issued CDs. What happens if the client dies before the CD matures? The answer to that is really all in favor of the beneficiaries. They usually have a window of time, typically 6 months from the date of death, where they can make a decision as to whether to continue to hold the CD until maturity and collect the interest payments in the meantime, or by providing proof of death, death certificate to the bank, they are able to redeem the CD at the original principal amount anytime within that 6-month window. So they really are the ones driving the bus. They're in control. They can either keep the CD or get 100% of the principal back with proof of death. How is the interest calculated? Several different ways. I'm going to walk through these very, very quickly because I don't want to keep you tied up too long here. I want to get to the questions that you're typing in. We have the AutoCap methodology, pure point-to-point, annualized point-to-point, and something that I call the minimum maximum. The AutoCap might seem a little foreign to some of you who haven't looked at these products before in the past. It's a little bit different. Everything is calculated off of what we refer to as the initial share price. It would be as if you had purchased a basket or a portfolio of 10 individual stocks all on the same day. And you would know what price you paid for each of those 10 individual stocks. That's the initial share price, the price that was paid. The AutoCap calculation works only off of the initial share price. There is no annual reset. In other words, you're not starting over year after year. If the initial share price is 100, that's the price you paid on that stock. 1 year from now, on the calculation date, you would compare the current price to that initial price, and the difference would be the gain. At the end of the second year, you would compare the price at the end of the second year to the initial share price again. So you're always going back to that initial share price. The interest on an AutoCap calculation is based on the average performance of a basket or portfolio of 10 stocks or commodities, subject to the AutoCap and to the floor. As long as the calculation date share price is equal to or greater than the initial share, then the reference share is credited with the AutoCap amount for purposes of calculating the annual interest payment. I'll say that one more time. On the calculation date, as long as the price is equal to or greater than the initial share price, the client is automatically credited with the cap for that stock. Then those 10 stocks are all averaged together, positive and negative, and that average is the interest paid that year. The basket floor is kind of like a reverse cap. The basket floor serves as a safety net because it limits the negative impact on the interest calculation of a stock going down. Typically, you'll see a basket floor of 15, 20, 25, or 30%. It's what I like to call in-run insurance. In other words, since you're going to average this basket of stocks to get the total return, you don't want to have one stock tanking completely and destroying the yield for the duration of the CD. It's kind of like in-run insurance. It's a stop loss. It's a limit to how much a negative can affect the calculation. So real quick, on the calculation date, or what we would call in the insurance industry the anniversary date, we compare the initial share price to the current share price for each individual stock or commodity. If the share price difference is negative, we credit each of those stocks or commodities with the negative, but not more than the floor. If the share price is not negative, meaning it's equal to or greater than the initial price, we credit that stock with the cap. Then we add them all up, all the caps and all the negatives, divide by the number of stocks in the basket, and that's the interest payment for that year. For a better explanation of this product or to ask questions during the explanation, be sure and give your business consultant a call. They'll walk you through the calculation. It's really quite simple. We have a number of products recently that are what I would call pure point-to-point. The Morningstar Ultimate Stock Pickers Index would be one example of that, where you have a starting point at the beginning of the term and an ending point at the maturity of the CD, and it's usually linked to an index, and you just measure the gain in between those 2 points. Very much like the very first fixed indexed annuities were. Those were 7-year point-to-point products. The banks are doing the same thing, but with some more exotic indices right now. The other one that you'll see, especially when on the high-yield bond-linked portfolio or market-linked CD, is something that I call annualized point-to-point. And that is where you measure from the initial share price or the initial index price on the to the anniversary date. And you annualize that. So at the end of the first year, you divide it by the number of years. That would be 1. Then you go point to point from the initial share price to the calculation date on the second year. And you take that gain and you divide it by the number of years, which in my example now is 2, and so forth. So you are going point to point, but you're annualizing it so that the CD can pay an annual interest payment. So it's point to point divided by the number of years and paid annually. The minimum or maximum products are really very simple. They're linked to a basket, usually of 5 stocks or 5 commodities. If one or more of those stocks is negative, the client's going to receive the minimum interest payment, in this example 1%. If all of those stocks or commodities are positive, the client is going to receive the larger number, 7%. They're going to get either or, nothing in between, no averaging. So as long as all of the stocks are not negative, the client will receive the higher number. If one or more of them are negative, the client would receive the minimum guarantee. One of the first questions we always get asked, and I've put it last in this presentation, is what marketing materials are there? How do I market this thing? And well, if you go on the website on our agent portal, you'll find that there are a number of bank brochures and a number of great point of sales pieces there to help you talk with your clients about the product. What we find them lacking in, though, is although they're not bad as point of sale pieces, they're not particularly good at necessarily getting you in front of prospective market-linked CD purchasers. That's why we like a product that I've talked about a number of times called the Entree Marketing System. It comes from a third-party vendor, but it's very, very good at getting you in front of the right kinds of people. There is a nominal charge for it. If you have questions about the system, you can give me a call directly or send me an email. I'll be happy to chat with you regarding the system and why we like it so much and how you might want to use it in your practice. But it's designed to get you in front of centers of influence, community leaders, high net worth individuals, and of course owners of traditional certificates of deposit. So we found it to be a very, very effective tool and would love to chat with you about it if you are interested in adding a marketing tool to your practice. Okay, with that, those are my questions, and so I notice a number of you have typed in your own questions. If you have a question that I didn't hit on and you'd like to have me address it, please go ahead and put that into the chat box on your control panel, and I will respond to as many of them as I can. We have a few in here already. Let's see. Fred asks, a good question, Fred. Is there an advantage to buying 12 $1,000 CDs of the same as opposed to one $12,000 CD? And first of all, the direct answer is you don't have a choice. These are issued in $1,000 denominations. But I would say that, yes, there is an advantage, and that is something I alluded to a little bit earlier, and that is that would allow you to, in essence, do a partial liquidation in $1,000 increments. So if you had a single $12,000 CD, say a traditional $12,000 CD, your option is to liquidate the whole thing or not. With 12 $1,000 CDs, you could take a portion of that out and liquidate, say, $2,000 worth. So I think there is an advantage to the $1,000 increment in a number of circumstances. Lester asks, are the market-linked CDs isolated into a separate offline account, or are they commingled with the conventional CD accounts? Actually, Lester, my understanding is what the banks do with these is they count it as a deposit, and it would, in all likelihood, I guess, be commingled in their general account. These deposits enable them to purchase or to borrow money at a discounted rate, which they then reloan out in various forms, whether it's real estate, commercial, or business loans. So I don't think these funds are treated any differently than a traditional CD is. Gary asks, could you please review the application process? I hope that means you have a case, Gary. Be happy to. The applications, there are only 2 applications. You can find them on the agent portal section of our website. One is for qualified money, one is for non-qualified money. If you've been filling out FIA applications, these are very, very simple compared to those. 3 and 4 pages. I mean, you know, doesn't get much better than that. I remember the first FIA application I took. It was actually the back page or the back side of a trifold brochure. That's all that they needed. Now you've got tons and tons of disclaimers. So the MarketLink CD application is nothing like that. 3 or 4 pages. You complete that, have the client sign it. You need a photo ID, a current photo ID from the client, and of course you need a check made out to Provident Trust. When you've acquired these things, you fax them to us, where we review them for suitability and also for completeness. If everything is good on the application, you'll hear back from us usually within 2 hours. That the application is good to go, or that a couple of things need to be modified. Once the application is ready to go, then you send it by UPS or FedEx to Provident Trust. You get a tracking number. You notify us of the tracking number. This gives us proof of delivery. So in the rare event of Provident misplacing the check or the application, we do have proof of delivery, and we will be able to go ahead and complete the transaction even if something unexpected happens. Once the account is opened, Provident Trust sends a welcome package to your client, thanking them for opening the account and sending them a statement reflecting the money that they sent is being held in cash. On the settlement date, when Provident purchases the CDs for the client, the client is entitled to a confirmation statement from Provident Trust, and they will receive that from Provident Trust once the CDs are purchased, and then they will receive an updated account statement every time interest is paid. So that, very briefly, Gary, is the application process. It's really pretty simple and straightforward. Your business consultant would be more than happy to walk through the forms with you. In fact, we frequently walk through those forms prior to you taking an application so that you can do it smoothly and seamlessly. Let's see if we have any more questions here. David asks, how do local banks generate interest? And David, I'm not sure if you mean interest in their products or the interest that they pay. But local banks do it in much the same way, just not as varied as these global banks. Okay, we've pretty much gone through what I consider to be our time limit at this point. I try not to keep you here much longer than 30 minutes if I can. I know you're very busy. We greatly appreciate you taking the time to spend with us today. It feels good to be back in the saddle, and look forward to being with you next week. Same time, same place for the June product launch. Until then, have a great week.